Good morning. Let's walk through the global financial markets today, June 26, 2025. Over the past 24 hours, global financial markets have been shaped by a mix of easing geopolitical tensions, diverging central bank policies, and continued strength in technology, especially artificial intelligence. United States stocks, led by artificial intelligence-related companies, remain near record highs, with the Standard & Poor's 500 index just below its all-time closing. While the Dow Jones dipped slightly and the Nasdaq rose, the overall market is consolidating at high levels, reflecting both bullish sentiment and some investor caution as they await new catalysts. Bitcoin also edged lower, trading around $107,500. The rally in United States equities is highly concentrated in a few mega-cap technology names like Microsoft and Nvidia, both of which hit new highs, driven by surging artificial intelligence demand. Micron Technology also benefited with strong revenue growth. This concentration means that while tech is booming, other sectors may be lagging, and the overall market's health could be less robust than it appears. In the United Kingdom, the market is more diverse. Cavendish reported strong results and a dividend increase. Volex grew thanks to electric vehicles, and Made Tech rose on government spending. 3i, a private equity trust, traded at a premium due to strong performance from its main investment. However, PZ Cussons disappointed investors with a strategic decision. This contrast with the United States shows that while artificial intelligence is a global theme, local fundamentals and company choices still matter. Nike's upcoming earnings are also in focus. Globally, equity markets were mixed. Europe saw gains, with Germany, France, and the United Kingdom all up slightly. In Asia, Japan's market rose on trade deal hopes, but China and South Korea slipped, and Australia was flat. This patchwork performance highlights the influence of regional factors and trade policy uncertainty, especially around United States tariffs. Bond markets saw United States Treasury yields ease, with the 10-year falling to 4.27%. This followed Federal Reserve Chair Jerome Powell's testimony, where he signaled patience on rate cuts but acknowledged that tariffs could slow the economy and inflation, possibly requiring easier policy. Other Treasury yields also declined, and recent auctions showed strong demand, especially from foreign buyers, helping the United States finance its debt at stable rates. Globally, government bond yields diverged. The United Kingdom and United States have higher yields due to cautious central banks, while Switzerland's yield is near zero after a rate cut to combat deflation. This divergence creates opportunities for investors to seek higher yields or engage in carry trades. Mortgage rates in the United States have dropped, with the 30-year refinance rate at 7%, the lowest since early April. This is a direct result of lower bond yields and could boost refinancing and consumer spending, offsetting some negative effects from tariffs. The United States dollar weakened notably, with the dollar index down 0.3%. This was driven less by economic data and more by political concerns, specifically speculation that President Trump may replace Federal Reserve Chair Powell early, raising fears about the central bank's independence. As a result, markets are pricing in faster and deeper rate cuts. The euro, British pound, and Australian dollar all strengthened against the dollar, while the Japanese yen slipped. Oil prices stabilized after a sharp drop earlier in the week, thanks to a fragile ceasefire between Israel and Iran. United States crude traded around $65 per barrel, and Brent at about $67. However, the ceasefire is seen as tenuous, and energy markets remain sensitive to geopolitical developments. On central banks, Powell reaffirmed the Federal Reserve's commitment to maximum employment and stable prices, with rates held steady. He emphasized a wait-and-see approach, especially given tariff uncertainty, and noted that the Federal Reserve is slowing its reduction of bond holdings to ensure ample reserves. However, political speculation about Powell's future is adding risk, as markets fear a more politicized and dovish Federal Reserve. Federal Reserve facilities like repo operations and the discount window are functioning normally with no signs of liquidity stress. However, as the Federal Reserve continues quantitative tightening, the market could become more sensitive to liquidity shocks. In Europe, the European Central Bank is leaning dovish, with Vice President de Guindos warning that Middle East conflict and United States tariffs could slow growth and inflation, possibly requiring further rate cuts. The European Central Bank is also pushing for a digital euro and updated regulations for financial innovation. Its latest projections see inflation at or below target for the next few years. The Bank of England is using new models to forecast growth and held rates steady, likely waiting for more data before cutting. The Bank of Japan kept rates unchanged and will gradually reduce bond purchases, signaling caution as Japan's economy recovers only moderately. The Bank of Canada is watching core inflation closely and may ease policy further, while Australia's central bank is expected to cut rates soon as inflation falls and growth slows. The Swiss National Bank cut rates to zero, responding to falling prices and a strong franc, and may go negative if deflation persists. Money market funds are shifting from treasuries to repo agreements as the Federal Reserve tightens and the composition of holdings is evolving. Government funds are buying more treasury bills, while prime funds are increasing repo and commercial paper exposure. The market could become more vulnerable to liquidity shocks as quantitative tightening continues. United States M2 money supply fell slightly month over month, but is up over 4% year over year, suggesting a mixed picture for inflation and liquidity. Options market activity in the Standard & Poor's 500 index was balanced, with high volumes in both calls and puts, indicating no strong directional bias. However, some strikes saw unusually high activity, suggesting hedging or speculative bets on a correction. Zero-data expiration options are now very popular, and both retail and institutional investors are using options for risk management amid uncertainty. In penny stocks, Surf Air Mobility saw heavy trading but fell sharply after a share sale. Plus, therapeutics surged on drug approval news, and SeaStar Medical rose after taking steps to regain compliance with listing rules. Corebridge Financial announced a major reinsurance and asset sale deal worth $2.8 billion, which could impact its financial structure. The Securities and Exchange Commission is also working to streamline regulatory oversight between two major industry bodies. The trucking sector remains under stress, with Integral Express filing for bankruptcy, reflecting ongoing weakness in logistics and supply chains. Other business news includes Vodafone Idea seeking new loans, Jio Financial Services investing in its payments arm, Hindustan Unilever acquiring a majority stake in Quality Walls India, and several other companies making strategic moves or raising capital. Broader trends show consumers are becoming more value-focused as confidence wanes. There's also talk about the impact of tariffs expiring soon, and the tech sector is exploring futuristic ideas like space-based data centers. Politically, the prospect of President Trump replacing Powell is driving market moves, weakening the dollar and lowering yields as markets anticipate a more dovish Federal Reserve. The fragile Israel-Iran ceasefire has stabilized oil, but risks remain. North Atlantic Treaty Organization leaders are backing Trump's defense spending targets, which could affect budgets and defense stocks. In summary, the United States equity market is strong but narrowly led by artificial intelligence giants, making it vulnerable to shifts in sentiment. Central banks are on different paths, with the Federal Reserve's direction now heavily influenced by politics. Geopolitical and trade risks remain high, and markets are likely to react quickly to any new developments, especially around the Federal Reserve's leadership. For investors, several opportunities stand out: going long on the euro or British pound against the dollar, investing in long-duration United States treasuries, focusing on artificial intelligence infrastructure and select United Kingdom value stocks, and using options to hedge against downside risk. Diversification, close monitoring of political and central bank developments, and a focus on fundamentally strong companies are recommended strategies in this volatile environment. Staying agile and data-driven will be crucial, as rapid shifts in sentiment and policy could create both risks and opportunities in the days ahead.